Did you know that 7 out of 10 Americans who have medical bills say that they have to lower their spending on food in order to avoid a medical bankruptcy? Navigating our highly complex world of healthcare and health benefits leaves many people feeling like a snowball in, well, you know where. I'm Josh Butler, healthcare consultant and advisor to more than 150 employers around the country, and this is A Snowball's Chance in Healthcare, a show about restoring hope in healthcare. Join us as we discuss ways you can lower your healthcare and benefits costs, how companies are winning the healthcare and benefits battle, and how hope is being restored to this community and communities across the country. Hello again, and welcome to another episode of A Snowball's Chance in Healthcare. I'm Josh Butler, president of Butler Benefits and Consulting. Again, I'm here in my office again this week, and each week we're sharing tips and strategies with employers and their employees to give them a snowball's chance in healthcare. And today, Michael Smith is back with me. Michael is a consultant as well here at Butler Benefits. Welcome back to the program, Michael.
Hey, thanks, Josh. Appreciate you having me on.
You bet. I know that you're just a couple of doors down today, but how's your fall going so far?
Really well. We're experiencing some nice weather, at least in the Texas Panhandle. A little bit odd from the norm, a little bit of cooler temperatures and a little bit of moisture. So that's great.
Well, you know, the old joke is like, if you don't like the weather in the Texas Panhandle, wait about 10 minutes and it'll change. But we sure did go from having a pretty warm summer trend going on till now. I'm waking up in the mornings in the low 50s, and you know, it's been rainy and cloudy for the last couple of days. I dig the fall. It's my favorite time of year. It's football weather. It's deer hunting's fixing to kick off and things like that. So it's my favorite time of year. Just celebrated a birthday, so you got me a nice gift. I appreciate you taking me out, and we had a good time. But
Absolutely.
What else is going on during the fall season? What are we going to talk about today?
So really one of the biggest things, if not the biggest thing from our industry standpoint, has to do with, we just entered into the fourth quarter. And so from a calendar year perspective, that's when really a majority of businesses and employers really kick off their renewal season for their healthcare benefits. And so that's one of the big things between renewal and open enrollment for their employees. So really one of the busiest times of the year for us and for the industry as a whole.
Absolutely. You know, a lot of companies, they renew their benefits this time of year. It's what we would call our tax season. It's our very busy time of the year. And I know a lot of brokers and consultants may listen to this program and watch our episodes, and they're going through it too. And fortunately for most of our clients, they only have to experience it once. We get to go through it dozens and dozens of times with our clients during open enrollment. I love this time of year. I like staying busy. And, but we wanted to kind of talk to employers today, and we wanted to kind of break it down like we do a lot of segments. We talk a lot to smaller employers that maybe you're fully insured, or maybe you're a larger employer and you're self-funded. Because those renewals look a little bit different, whether you're self-funded or you're fully insured. So we're going to talk a little bit about that today. And usually what I really want to get into is I want to kind of cover, what we would consider, the status quo model. And, I know there's a lot of debate in our industry between what's the difference between a broker and what's the difference between a consultant or an advisor. And to us, we understand that those words can be used interchangeably in our industry, and a lot of people do. But really, where I see a distinction is a broker is more like of just a seller's agent, right? They're selling a product, or we sell product, and we do plenty of that. We do plenty of brokering. We sell plenty of insurance policies, and but I also think that consultants and healthcare advisors go a little bit further in that process. And so today we're going to talk about that and address it. But let's talk about some of the status quo approaches to a renewal, and what employers this time of year, as they're preparing for open enrollment and they're preparing for their conversations with their brokers and consultants, that we're going to challenge them to ask some tougher questions and to dig a little bit deeper and to raise the standard when it comes to your interactions with your brokers. So take us through a couple of items, Michael, of what your experience, you've done enough of that. You've done a few of these with me already this year. Is, what are you starting to see kind of emerge as status quo type This is what happens every year. And employers feel the same way, right? They're just like, oh, it's open enrollment time, and they'd rather wrestle a tiger in a phone booth than, do open enrollment. But what are some of the things that you see that are just basic status quo things that we need to correct?
Yeah, absolutely. And I like your analogy there. It's really a struggle. It's one of the last things that an employer, especially if it's whether it's a CFO or an HR professional or a team that a company puts together to really evaluate what's going on within their health plan. And so it is like pulling teeth sometimes because it's kind of one of this arduous type of a painful process that some people go through. However, we do a really good job of with our team in making that process really silky smooth, something that we get all the information up front, and some of that information has to do with really just looking at your data. What kind of data do you have at your fingertips? If you're in a certain small business segment versus maybe a mid-size company, you're going to be looking at different types of data maybe that's available to you based on who your carrier is and what types of reports that you have at your fingertips. So there are things that we really feel compelled to let people know that this is your data. You have the ability to request that, to get as much of that data that you can from that carrier. Now in Texas, it's a little bit easier just because we do have what's called House Bill 2015 that I know you have covered in length in previous episodes. But that's one of the areas where we start with, if employers don't already have some of the data that they can work within, then really that's kind of a first step in making sure that they have something that is in front of them that we can walk them through and help them understand what it is that's going on within their population, and some of the claims that are out there, some of the employees that are driving up some of the healthcare utilization that they have, and then just helping them understand a little bit more about what their plan is doing and how it's performing.
Yeah, absolutely. I mean, we've said it many times. You can't manage what you don't measure, and we're going to get more into some of the details here in a minute. But I want to back up a minute, and I want to address something that I've witnessed for many years is that at open enrollment time, employers, it's probably the only time they're taking a good hard look at their employee benefits or their loss ratios, and we just feel fundamentally that healthcare is something that needs to be managed throughout the course of the year, not just something that you analyze, once every 10 months, or once every 12 months, one time a year. We call it set it and forget it. And that's one of the reasons that we see healthcare costs just continuing to drive up, is that it's not being proactively managed throughout the course of the year. But the issue that I want to address is how employers, the process typically looks something like this. Let's say you renew your benefits every year on January the 1st. It usually starts, the process of open enrollment typically starts about 90 days prior, maybe 60 days prior in some instances, depending on your carrier, where your broker, or maybe you will get your renewal. Your broker will be given the renewal from your incumbent insurance carrier, and we will start this kabuki dance back and forth. They go, and you might get a 15% increase, and so the broker says, let me go back to the carrier and see if I can twist their arms, or I'll go out and get you some quotes. But Michael, they might be able to shave off 5 or 6 points here and there, and a lot of times the broker just says that this is how I show my value. You got a 15% increase. I negotiated it down, or I twisted their arm hard enough, to get them down to a 10% increase. And I suppose there's some value in that, because you went from a 15% increase to a 10% increase. But the bottom line is you're still getting an increase. And we're seeing this trajectory. And I think that that's a reason why so many employers have given up hope that anything meaningful can be done in healthcare. Is just we've experienced it for so long. We've seen this trend, this upward trend for so long, that they don't know what else to do. It's hard to do something else when year over year over year, you keep being presented the same 3 or 4 options from the same sets of brokers. Would you agree? So here in the Texas Panhandle, we work in a lot of places around the country, but Michael, here in the Texas Panhandle, talk specifically to the employers here in the Amarillo area. What options in the status quo model, in the historical model over the years, what have been their options?
Typically the options have included about 4 or 5 different types of carriers that are, it's reduced down from what 20 25 20 years ago, that now down to just 4 or 5 in this area of the country. And so it has dramatically reduced the options that are available. Now there are a ton of different plans within each one of those carriers, but at the end of the day, they all do about the same thing. They all have about the same level of coverage, and the network expansion. It's really not anything that they have just a whole lot of creativity when it comes to options for the.
But let me ask you a question, Michael. I mean, we're both licensed insurance people. You work here at Butler Benefits, and we're both, in consulting and broking and things of that nature. Let's say we were competitors.
Sure.
Is there anything I could sell that you couldn't go? And when we're talking about access to those 4 or 5 companies, I mean, we're basically boiling it down to Blue Cross Blue Shield, United Healthcare, Cigna. Then you've got Scott and White Health Plans, as previously First Care. I mean, so I've heard people even make comments to me like, well, all brokers are the same. You all quote the same insurance policy. So the way they choose a broker is often relational. It's very like, well, I go to Sunday school with my broker, or I play golf with my broker. I went to college, we were roommates, or maybe we're drinking buddies. I don't know. So, typically we see that, in the selection of a broker is much more relational than it is, the types of solutions that are being brought to the table. And so that's why we wanted to kind of have this conversation today, that we feel here at Butler Benefits that really employers this time of year, obviously you got to make decisions on what carrier are you going to go with? What's your deductible going to be? Are you going to be in a PPO or an HMO? Are you going to self-fund? Are you going to level fund? Are you going to be fully insured? Of course, those are all decisions made around your plan that are very, very important decisions for the next 12 months going forward, because that's how your employees are going to be covered. But oftentimes employers that are making those decisions at the same time, they're also making a decision of which broker they're going to work with, which consultant they're going to work with. And it's almost like this sense of obligation that if Michael brought me the best quote or the lowest quote, then I'm going to go with him as my broker too. Michael, let's talk a little bit about that. I think there's some danger in that, because it just trains our market that the value of a broker is in the quote and the illustration that they bring to you. And it just leads to a race to the bottom, is which broker can come in here and show us, the cheapest plans that will reduce our costs without completely gutting our plans. And, how are you going to differentiate in a market when everybody can quote the same products?
No, you're absolutely right. That's the two distinctions there that you're making there, is between, the plan that the employer is going to ultimately go with, and then the broker slash agent or consultant that they decide that they want to work with. Maybe there's a good fit, a good relationship. Maybe like you indicated earlier, having this long-standing type of a personal relationship with somebody that they feel comfortable with, but maybe they're not the one that's bringing the best innovative ideas or the best creative solutions to the table. So it is two very distinct decisions, but oftentimes you're right. Someone who is bringing, the rock bottom dollar premium and overall spend to the table is what they're looking for, and they're not really considering any of the other options that would be a betterment to not only their plan, but to their employees and some of the out-of-pocket experiences or pains that they're going to have. So, therein lies part of the issue is that just because you and I are competitors, and we bring in and we quote different things, we still have the ability to quote the same exact types of plans or plan designs. That in a fully insured environment is going to be, it's going to be apples and apples all day long. And so I can bring in something that's low, and then when you find out that I brought in something low, you can go in there and find either the same thing or something maybe just a hair lighter. So
yeah, and so to me, it's just like that. That's our value proposition as brokers and consultants, is not in our ability to go out and get a bunch of quotes. It's not, I can get a quote with Blue, I can get a quote with First Care, and so can you, and so can the next broker, and so can the next firm. And so really what I feel like they're two distinct differences. And when employers really truly understand the value of the appropriate value of a broker and what a broker can do for an organization, then perhaps, and I think that we have the responsibility. This is we've trained employers, to treat us this way, is because it's often, like I said, a race to the bottom. Whoever can bring me the cheapest quote, because there are companies out there that are strictly making their decisions on price. But we know, and we've said this a million times, even on this program, is that price is only one element of value. And so there's other areas of value that brokers should be bringing to the table that if your brokers aren't, then, there's some good questions. And it dovetails into what this program is about. It's about giving people education, information, data. You can't manage your health plan without data. You can't possibly, it'd be like trying to manage your household budget and you have no idea what your mortgage is. You have no idea what your car payment is. You have no idea how much your kids are spending at lunch every day. I mean, it would just be impossible to manage a household budget if you're not monitoring or at least trying to control what you're spending. Right. And so that's why we spend a ton of time getting data, getting information, getting claims data, getting utilization stuff, getting quality metrics, and looking for risk within a population, because we know this, Michael, a lot of risk can be managed, right?
Indeed, it can.
So on top of that, you're talking about bringing value. So ultimately, ladies and gentlemen, what we're talking about is making two distinct decisions between, obviously, you've got to make the decisions around your health plan, but understand, and we cannot emphasize this enough, you are plan sponsors and you have a fiduciary responsibility, not to your broker. You don't owe me anything. You don't have a responsibility to me. You have a fiduciary responsibility to your employees, your plan members. And so, yeah, it's great if we're buddies and we play golf every Friday and we've been lifelong friends. But if I'm not bringing you the solutions that someone else can bring you, it's not about our relationship anymore. It's about your relationship and your responsibility to your plan members, your employees. Your employees don't play golf with me every single Friday. So I don't think they care if we're buddies, Michael. You know what I'm saying? They don't care. They expect their employers to be looking out for their best interest, not trying to maintain a golfing buddy relationship. You know what I'm saying? I mean, do you agree with me?
I completely agree with you. And I think that that's where the hang up is, if this is your business and you're going to run it like a true business, you should be looking at every single way that you can to drive down costs and give greater value to your client. And so if we're able to come in and do the same thing for you, driving down the cost of healthcare, and in tandem with that, health insurance, your employees, and they're kind of a customer of yours as well, you're driving down the price of everything for them too. And so I think that becomes a win-win, because if you can impact your bottom line, but also impact what it is that those employees are actually spending out of pocket, everybody ends up benefiting at the end of the day.
That's true. And, I just want to, emphasize that, we understand relationships. We develop relationships with our client. We love our relationships with our clients, at the same time. But we got to stay on our toes all the time, because we don't take relationships for granted. We don't think, oh, they've been doing business with us for 20 years or 10 years or however long, that they're going to continue to do business. Because, as a professional, I just feel like if we're not delivering the best alternatives, the best results for our clients, then, we understand if they choose to do business somewhere else, if somebody else brings a better strategy or a better solution to the table. But we certainly understand and respect relationships. We're not trying to, be home wreckers here, so, but at the same time, we do feel like the health employee benefits is an area that most companies are struggling to control or optimize. And they just think, why do I need another broker? You can't do anything different than my broker. And that's a mindset that, we really disagree with, is that there's a lot of alternatives, strategies out in the marketplace. I feel like, and I've been saying for the last 5 or 6 years, that we're in the middle of a healthcare revolution again in this country, and things are evolving very, very rapidly. the passage of the Consolidated Appropriations Act is going to force a lot of this management and transparency and disclosure and risk management that we've talked about for a really long time. But as we kind of wind down here, Michael, we want to give the employers out there listening some tips here to wrap up the program. I know you've got some questions that, this open enrollment cycle, ladies and gentlemen, don't just do the song and dance. The thing that when I said earlier that you'd rather wrestle a tiger in a phone booth, I get it, because you just feel like I got to go through these motions every single year, and every single year the outcome's the same. I'm going to end up either switching to a different insurance company because they came 10% under my renewal, or I'm going to raise my deductible. They're going to get a raise, and I'm going to have to ask my employees for more money, or I'm going to have to tell them their rates are going up. And it's just frustrating because you feel like no matter what you've done in the past, the outcomes have always been the same. Well, ladies and gentlemen, this year, here's your opportunity to ask some different questions. Demand a little bit more than just, hey, your broker, here's our renewal. And if the broker walks in and says, well, I went to market and you just need to renew. Listen, guys, that's not good enough anymore. That's not going to get the job done. We have to start holding brokers more accountable to our profession. And, how about you just say, I want to see something a little bit different this year. And whether you decide to go with it or not, it's a great exercise to make your broker work a little bit, instead of just saying, let's rubber stamp, this plan one more year, because that's the easy buttons. But Michael, give us a couple of examples of questions that employers should be asking their brokers during renewal season.
Sure. So let's just assume that you have access to your data, or that you've requested it, you have it at your fingertips. At that point, I think you can start asking some of these more sophisticated questions to get a look underneath the hood of your plan. And hopefully, most brokers are going to be able to answer this and be able to give you some explanation, or at least how we can help drive down some of the maybe negative trends that are out there. So you've got your data. One of the biggest key elements that most of us look at is your medical loss ratio, because that's going to be one of the key indicators of really how is your plan performing based on the amount of money that you're actually spending in claims versus the amount that you're spending on the actual premium. And so if you're upside down there and you're not spending very much in the way of claims, but you're spending a ton in the premium on a monthly basis for those carriers, that's a big problem. And that's something that you and your broker need to have more of a come to Jesus meeting about, because you shouldn't be spending that much money on the premium side if you're not utilizing healthcare. So that would be one of the major things there. One of the other things that I've always liked to talk about is, from an actuarial standpoint, do you know what the value of your plan is bringing versus other plans out there, and what that would mean to both your company and your employees? So we have the ability to go through and physically score a certain plan and compare it to other plans of kind of like or similar types, and give you a sense of where does it rank in kind of the grand scheme of things versus other plans that could add more value to you.
Yeah, absolutely. And so you're talking about the methodology that even the federal government used through the Affordable Care Act. And that's how they came out with platinum plans and gold plans and silver plans and bronze plans, is those are actuarially scored. And so, yes, we do that. And so, because a lot of times employers, you want to know, am I offering a high value? And these actuarial values are not actuarial values necessarily for the employer. They are for the person that's covered by the plan. And the higher that a plan scores in actuarial value, the more valuable it is to your employee. So, just a challenge there for employers is to say, think about it from an employee perspective. If you're moving everybody and shuffling everybody into a bronze level plan, or into a plan with an actuarial value below 80%, then you got to understand what that does to people and their perception of your benefit package at your company. And it's very, very important to those people. Benefits are the second most asked about thing at your company is, number one, what are you going to pay me? Number two, what do our benefits look like? And trust me, people are looking for value. They're not just looking for the lowest premium. We ask people all the time about their frustrations in healthcare, and a common response that we get, Michael, is that, yeah, 99% of people complain about the premium. The premiums are just too high. But right there in a close second is what?
It's the deductible that they have to pay.
High deductibles. I'm paying $2,200 a month for family premium, and I still have a $15,000 family deductible. So listen, guys, here's what I'm getting at is when companies, this is the frustration that I'm going to speak to here for just a second. That's the frustration. It's that they're paying $2,200 a month in premium, and they still have a $15,000 deductible on the other side of the coin. So they're getting it coming, and they're getting it going. And that's the diminished value that we have witnessed in our health benefits environment for decades now. So if your broker is not having conversations with you about how to solve at least one side of that coin, now it's very, very difficult to solve both sides of that coin. I'm going to make your premiums go down 30%, and I'm going to eliminate all your deductibles. That's pretty difficult to do, Michael. I'm not saying you notice that I said it's pretty difficult. Notice I didn't say it was impossible.
That's right.
Because it is possible with certain types of plan design and certain types of solutions and strategies. But real quick plug for Butler Benefits, we're doing this pretty routinely, where we're solving one side of that equation. We are getting people into very sophisticated health plans that in a lot of situations, it does lower the cost of healthcare 30 to 40%, and it eliminates people's deductibles, their co-pays, their co-insurances, and their out-of-pocket. Now, if I'm lying, folks, I'm dying. But because we do this for people, we've got a lot of references. So other questions that you talked about that I'll just add to. If you're a self-funded employer, what are your medical benchmarks? How is your plan performing against other companies in your industry, against your direct competitors? How is your health plan performing against some of the best run health plans in the country when we talk about benchmark figures? So those are great questions to add. You know, what is my per employee per year medical spend? What is my per member per month pharmacy spend? Who are my high cost utilizers? Who are the people? What are my high cost claimants? What are my high cost medications? How many diagnostic imaging services are we utilizing in a year? And what am I paying for them? So the other day I had a meeting with a company here in town. I won't say who they were, but you know, we got their data and we did some analysis for them. And we saw that they were paying, Michael, on average, $6,000 per CT scan administered in their plan over the last 9 months, because we only had 9 months of data that we were analyzing. Michael, real quick for the audience, tell the audience what our contracted rate is here in Amarillo for a CT scan. I mean, I know it's going to fluctuate a little bit, but give them even our high end.
You know, it's usually going to be between $400 and $500. You know, it stays in that range depending upon what part of the body and contrast and so on and so forth. But yeah, sounds like they paid at least tenfold what we can get it for.
10x. And if you so when employers start asking us, why are the premiums so damn high? Well, this is one of the reasons right here is because our plans are out there paying $6,000 on average for CT scans, whenever you could be paying $600 or $500, or like you said, $475 is our average. And so that makes a big difference. If you want to get control of premium, you got to get control of claims. And that's where we're giving people hope on this program, is you can get better control of claims through proper risk management strategies and solutions. And if your brokers aren't bringing you strategies and solutions that have a direct impact on the cost of care, then you don't ever have a chance of doing anything to impact the cost of your premium. And that's kind of a message that we relay all the time. Give you one last one, Michael. What's one last question that employers should be asking their employee or their brokers during open enrollment?
So one of the things that really is going to be, you touched on a minute ago, the Consolidated Appropriations Act, that is really opening up the transparency aspect of everything, has to do with what is your brokers or your agents, compensation structure look like, and are they sharing with you transparently what all of their direct and indirect compensation is? Because there are a wide variety of incentives out there that we're aware of that we don't participate in, but those are things that as an employer I would want to know who's acting on my best behalf, and what is it that maybe they're getting under the table or on the side that just for keeping my business somewhere.
And I think that most brokers operate pretty transparently with their clients, and I really do think that most brokers truly do have they want to do what's right by their clients. I just believe that. I believe the good in people before I believe the bad. I'm not a skeptical person at all, but I will say this: there are financial incentives that brokers earn in this industry that financial advisors don't get to earn them. And so for far too long, we know that there probably are some unscrupulous brokers out there that are advising their clients to purchase certain plans or to participate in certain plans because it's better for the broker than it is for the actual client. Because if you think about this, the most common way that brokers get paid is through commission. And if commission is tied to insurance premium, ladies and gentlemen, every single time you get that renewal increase of 8, 10, 12, 20, 30%, then your broker just got a 8, 10, 12, 20, 30% raise. And so there are very, very substantial bonuses to retain clients with certain insurance companies, to get new clients to come over to a new company. We've shared some of that even with journalists in the past of the financial misincentives that are in our industry. So asking and requiring, ladies and gentlemen, now it is a part of federal regulation that as the plan sponsor, that's you, Mr. Employer, you are now responsible for ensuring that your brokers fully disclose 100% of all their direct and indirect compensation. That's any compensation over $1,000, whether directly earned or indirectly earned through things like vacations, bonuses, golf clubs, whatever, any of these things that are given to brokers a lot of times. So it's a great question, Michael. It's a great point. Any last words? Who's going to win the Texas OU game this weekend?
I would love to say Oklahoma, but unfortunately, it's not. We've had a little bit of a slip and fall, and I'm not sure who's going to get off the bus in Dallas tomorrow.
Well, you mentioned slips and falls. I'm an Aggie fan, and so I don't really. I don't know who I would want to win between OU and Texas. I don't like either one of them very well. I hope they end up in a 0-0 tie, but the Aggies have done more than slip. All right. So I'm right there in that boat with you. It's going to be a fun weekend. Michael, thank you so much for chatting with me today. Remember, folks, ask good questions during open enrollment. Don't just make it the same dog and pony show. Ask good questions. Get your broker to get to work for you. Look for alternative solutions. Don't just settle for, 10% is the new normal. 10% increases are the new normal. No, they're not, ladies and gentlemen. You can control healthcare. There are solutions in the market. And each and every week, right here on this program, that's what we do. We share tips, strategies, solutions to give you a snowball's chance in healthcare. See you next week. God bless.